Hello, everyone. Welcome to this demo session for the SBR, your Strategic Business Reporting exam. This exam session is going to be held by me, and my name is Manpreet Kaur. I'm an ACCA member. So before I just start giving you guidance or giving you tips or start giving you an actual lecture on one of the SBR topics, I would like to take a moment and would want to introduce myself to you so that you know that you are at the right place when it comes to preparing for your ACC exams. So, I am an ACCA member who started my ACCA journey like most of you guys. I started my journey after my 12th standard, and then I was able to crack all the ACCA exams in the first attempt. So, this was only possible not because I'm super intelligent or I'm genius. No, not at all. This was only possible because I had a right approach for preparing for each exam. I did not waste my time into preparing or learning something or practicing something that I know would not come. Instead, I had a very disciplined and very smart approach when it came to preparing for each of my ECC exam. And I was lucky enough to get couple of ranks. I got All India 1 rank and World rank 5, I think, in Triple A and same in SBL exam. And I was also in AIR 1 in the overall ACC affiliate status. So, not just passing the ACC exams, but also with that, I have been working in the public practice industry since last 4 years now. So, I have practical experience. I have applied all the ACCA knowledge that I learned during my studies in audit exams or in FR exams. I've actually applied those theoretical stuff into the real world stuff, into the corporate actual financial industry. So I have a right blend of what it means to study for ACCA and what it means to be an actual ACCA, like um, how much knowledge you need for being an ACCA or an ACCA member, and what sort of guidance you need for cracking your each ACC exam. I think I would be in the best position to help you out with that. And I have been teaching ACCA subjects from last couple of years now. So I have some teaching experience as well. But why teaching? Because like so many people ask me that, oh, you have a corporate experience, then why do you want to go in teaching? It's something that I enjoy. It's something that I'm passionate about, not something that I'm just doing um, because I had to do it, but because I love doing it. So I hope all the information that I gave about myself would give you a little bit of trust that you are at the right place to prepare for your SBR exam. So, as you know, that today's lecture is the demo lecture, so we won't be covering like too much stuff for your technical knowledge. But at this point, because most of you are here, you want to know what should we do at the first day, like from the very beginning of our preparation day, what we should be doing to ensure that we are at the right track to clear our SBR exam. So, guys, I want to be very honest with you. SBR exam is one of the P level exams. You already know that. And it is one of the exam that would not just test your technical skills, but it would also test your professional skills, right? So if I talk about the SBR syllabus, so you should know one thing, that 60 to 70% of the syllabus is similar to what you've studied in your FR exam. right? So if you've already given FR and now you're taking SBR, so that's a good thing because your knowledge of FR would be fresh, right? So the syllabus is like similar to FR. Of course, like in each standard that you've studied, there will be an extra additional advanced knowledge that will be provided in the SBR textbook. But the base or the foundation of your standards would be similar to what you have studied in your FR. But here comes the twist. So the SBR syllabus, although it is just financial reporting, but they would not test your financial reporting in MCQs or in long questions. Like in FR, you had like maximum 70% of your exam was MCQ, and then the 30% of your exam is your theoretical exam. No, right? So SBR exam, it would test your practical knowledge. It would test your IFRS and your IAS knowledge to apply in the case, to apply in the case study, right? So you won't be asked a direct question like, oh, what is the, like, they won't give you a direct numerical question that, okay, what should be calculate what should be the depreciation, or calculate what should be the revaluation gain or loss, or calculate what should be the impairment loss. No, they won't be asking you straight questions in this exam. So they would give you a case study in this exam. In that case study, you would have to identify the issue, that what's going on in this case study, and identify what standard would be applicable. Okay, this would be the first step in your SBR case study. Like, you have to identify what standard would be applicable for the question that you are trying to solve. And because most of the questions are long questions, so you have to work on professional skills to structure your answer, to structure your answer, right? So first step would be identification, and then the second step would be explanation of the standard. This would be your second step. Now, when it comes to explanation of the standard, you don't have to, like, cram all the standards. You don't have to like learn all the details of the standards. No, but you should know the basic and some major terminology used in the IFRS or IA standard, and use that terminology to explain the accounting treatment, right? So, this is something that you should be careful about. Like, most people know what should be done, right? Like in FR, we know, like, if I'm calculating a revaluation gain, so I know that how it should be calculated. Or if I'm calculating impairment loss, I know how it should be calculated, right? But during that FR exam, we were just playing with the numbers, right? And in this exam, we are not just playing with numbers, but we are also trying to express our professional knowledge and to express our knowledge of the standard in the best possible way. So basically, if you're already working somewhere and someone asks you that this is the file you're working on and this is the issue the file has, right? So you won't just say, okay, this should be the solution, right? But instead, you would be more practical and you would be more professional, explaining that, okay, if this is the issue, then according to this IFRS standard, this is the correct treatment which the standard tells you to follow, and then you would use that knowledge in the standard to apply it to your work file, right? So similarly, so you explain the standard. You won't have to copy paste like 100% of the the wording that the standard says. But if you want to score good and if you want to increase your chances of being passed, then you have to at least learn some major terminologies. Like, for example, if someone says, I want to um like, tell me how should I calculate the impairment loss, right? So we have like few terminologies like value in use, like our net realizable value, our fair value, right? So we have to make sure that we are using some basic terminology while writing our answer, right? And then the third step would be apply your standard knowledge to your case study, link it to your case, and then provide solution, right? And then you have to provide the solution for that. So these three are like the basic steps which you were not doing in your FR exam, which you were not doing at your FR level. So this is something that you have to learn when you will be studying with me, because the teaching approach that I use for professional level exam like SBR is something that if you study those things with me, then you will start adapting to those things. You will start adapting those professional skills, those terminology, and you would be able to write your answer using those standards terminology in a very natural way. Because in the exam, you don't have to spend a lot of time remembering, oh, what was that. But if you revise it with me, on a regular basis, if you are learning the IFRS or IA standards in a way that you are getting used to that sort of knowledge, then using that sort of terminology, then it would not be difficult for you to write in the exam, right? So this is what our SBR exam preparation should be for, right? Not just for learning the standards, but also to be able to explain the standards knowledge in the exam. So as you know that there will be around 4 questions in your SBR exam. So if I just talk about the SBR exam format, there will be a section A and there will be a section B, right? And then in section A, you'll have 2 questions. One mostly comes from group or consolidation, and then the other one comes from your ethical standards. Like, the second question would not be like completely ethics, but it would have a component of ethics and some other IFRS standards and or standards, other IFRS standards, excluding your consolidation. And then the second section B, it would also have like 2 questions from your normal IFRS standards, like excluding your consolidation. Like, consolidation is mostly tested at section A level. They might ask you again in section 2, in section B, but rare case, right? Here, mostly, like, sometimes they also ask you about ratio analysis, um, explaining the variations or explaining the factors which affects the financial position or performance of the company. So this is basically your exam format, right? So how are we going to prepare for this exam? So the first thing that we have to keep in mind is that we have almost 2 to 2.5 months for preparing your exam, right? So in most of the cases, it's 2 months or 2 months and 1 week, right? So what I suggest everyone is that within 1 to 1.5 month, you cover your syllabus, right? And when I talk about syllabus, not just syllabus, but with the syllabus, you also do practice kit at least once, right? So if you will be studying with me, so I would always target completing your syllabus before 1 month. And if least it could go is first week, like for example, if you are giving your exam in December, then I would try to finish the exam syllabus by October 31st, or maximum it would be dragged till first week of November. That's it. By first week of November, we should be done with the syllabus and the practice kit once, right? So I would teach you each IAS IFRS standard, and we will do, first of all, we will understand that standard. We will do some questions already in the study text to get a grip of the standard. And then for practicing, I will help you to practice few questions from the exam kit which relates to that particular standard, right? So exam kit as well, right? So there will be some long questions that we will be discussing in the session itself, and there will be some questions that I will give you on a regular basis to solve on your own. You will write, you will actually solve that question and send it back to me. I will review the structure of your answer. I will review the wording you have used. I will suggest you what changes you can do, how you can make it better, and then return it back to you. Okay, so this will be my job. My job is not just teaching you, but my job is to prepare you well for the exam. That when you write the exam, you should not write the exam as an ACCA student, but you should be writing an exam as an ACCA professional, someone who is already clear SBR. You should be writing your actual exam with that level of confidence. So that is what you will be getting from me. Okay. And then in the last 3 to 4 weeks, we will be revising all standards again and doing exam kit again. Along with it, I would give you some tests on regular basis, like weekly test or bi-weekly test. So in 1 week, I might give you some questions to solve from your exam kit, and I would say, okay, give it back to me. I will review it. But maybe in the next week, I will take your test of specific standards. I will give you questions outside your Kaplan exam kit, maybe from previous year papers, maybe from some other practice kit, and then you will send it back to me, right? So guys, because this is an online interaction, then most of the questions that you solve, obviously there will be somewhere in the world that you can get answer for that question. But it is your loss. It is your loss then. Because then you're not giving an honest answer to me, and I would not be able to give you an honest feedback to you. So whenever you're preparing or whenever you're writing any exam or any question that I have given you to solve, please use only your knowledge. Sometimes I have seen students who are giving me perfect answers because they have got some solution from somewhere else on the Google, or they've searched it somewhere and they've got the solution. Please don't do that with me, because in the end, it is not my loss, it is your loss. So I want you to be very, very clear that if I have given you something, you're going to attempt it with utmost honesty, right? So there will be test on regular basis, and then there will be mocks. So one mock I would conduct when you complete the syllabus, right? So normally I prefer 3 mocks before final exam. One mock should be when syllabus is complete, to get an understanding of where you stand. Okay, then accordingly, we will be doing more of like more mentoring sessions with you that would help you to focus on your weaker areas, right? And then second mock will be in between revision session or revision timeline, and then third mock in last week of your exam. Okay, so this is what we will be doing together, right? So I will be giving you the recordings, I will be giving you weekly plans to follow. I will be giving you targets that in this week you have to go through this section, and you have to solve these many questions. And then weekly, we will have one-on-one mentoring sessions, right? We might have a group sessions together, or if someone is having a lot of problem, then we will have one-on-one session, one-on-one call, and then I can help you to work on your weaker areas, right? So that's what we are going to do. If you have any other questions, then do let me know. If you have any other doubts for your SBR preparation, then of course do let me know. I'm here to help you. I'm not here to just be a teacher and teach the standards and go. I'm here to support your journey of passing your ACC exam. That is what you are paying me for. Okay, so do not feel hesitant if you have any sort of questions, if you have any sort of doubts, just feel free, text me, call me, just let me know. Okay, just before calling me, just drop me a message and ask me if it's a good time to call, and then we can have a call, right? Okay, so moving forward, I would go through the SBR syllabus once with you all. Okay, so this is the Kaplan exam kit that we will be following. Okay, guys. So this is the syllabus that we have for our SBR exam. And if you look into most of the chapters here, you would see that some of the standards you have already studied in your FR. If there are any if you have not given your FR exam because you got some exemption, or you're coming from a different route, then it's fine. Even if you have not given your FR exam, I am anyways going to teach you each standard from the very scratch, from zero level. Okay, so you don't have to worry about it. But for those people who have already given your FR exam, then most of the topics here would be familiar to you, right? For example, revenue, IFRS 15, that's something you've already studied, right? Non-current assets, your PP&E, your intangible assets, your impairment, that also you have studied in your FR. Inventories, foreign currency, leases is something that you have already studied. In leases, there are some additional topics that will be introduced in the SBR, which you have not studied at FR, but again, half of the leases is same. Employee benefits, share-based payments is new. You have not studied this before. Chapter 11 is IAS 37, your events after reporting period. This is your provisions, IAS 37. And then your financial instruments is your IFRS 9. So many students hate this chapter, but I promise I'm gonna teach you this chapter in such a way that you will never hate this chapter again. Okay, then we have tax, our deferred taxes we will be studying here. Segment reporting is something that's new. Related parties, SMEs, these chapters as well, like these are little bit new to you, like and then comes your consolidation, your group accounting, basic groups. This is something you've already covered. Change in group structure is new at SBR. Foreign currency is new. Group statement of cash flows is new. Okay, analysis and interpretation, this is same as your ratio analysis. So nothing major to be worried about at this point. So, for the students who've already given FR, this looks familiar, right? So yeah, and even if you've not studied FR, I'm saying it again, you don't have to worry it because I'm going to teach it anyways from the start. So today I will be starting from chapter 5, non-current assets, Why I will be skipping these first couple of chapters? Because frameworks is a very basic chapter. It just helps you understand what are the basic principles or what are the basic foundation on which are all the IFRS standards are made. Like what is the foundation or what are the guiding principles when they design each standard, right? What are the common things that each standard has? What is the framework? What is the foundation? So if you study all the standards, then you study chapter 1, then it will make you more sense than if you just start with studying with chapter 1. Okay. So that's why I just covered chapter 1 in the end, because when I read chapter 1, then everyone knows what I'm talking about. Everyone has already seen those stuff. Chapter 2 is your professional and ethics chapter. It is nothing but your code of conduct, your ethical principles, yourself, your threats to independence, or things like that. They're like very basic. So we will be covering this in the end. Performance reporting and revenue. There are some topics in both of these chapters which are new at SBR level, and they would require more concentration, more attention. So I would not start with the first lecture starting with any of these topics, because I want to build momentum of your preparation first. I want to bring you guys into the flow of studying for SBR, and then we will touch with these chapters. Okay. So the first chapter we are going to look into today is your non-current assets. Okay, so this is the chapter we will be starting. And guys, okay, so one thing I want to make it very clear, I will be using your Kaplan study text to teach you stuff. I can give you my own notes. I can, prepare own different notes in the class. But why I teach you from the study text? Because again, guys, this is a theoretical exam. You have to write in the exam. So, if you will be reading the study text with me and understanding each and every statement in the study text, and you will have confidence that whatever statement is mentioned in the study text, I understand it, right? If you read the study text and if you understand it properly, then it will be very easy for you to frame an answer, because you will be comfortable. Again, I mentioned before, we have to use specific terminology, right? So if you read the stuff with me in the class and then you go home, you revise it on your own, you're reading it twice. So you get comfortable with the concepts, you get comfortable with the terminology, which will help you to build your professional skills and which will help you to prepare for your exam in the best possible way. Okay, so let's get started. Okay, so, non-current assets is the term that we have been studying like so many times. We have studied this when we were um in our in our commerce stream, or when we were studying for a bachelor's, right? So non-current asset is something that is not current. Current is which will be used in the 12 months or in one financial period, right? But non-current is which will remain more than one accounting period, which will be used in the business, which would be used in the entity for more than one accounting period, right? So in the non-current assets, we would not just be studying our normal like PP&E, but in this chapter is a combination of multiple standards. For example, property, plant, and equipment is your IAS 16. Very important standard, gets tested very frequently. Intangible assets, your IAS 38. Okay. Your impairment is IAS 36. Your investment property is IAS 40. Your assets held for sale is IFRS 5, non-current assets held for sale. Your borrowing cost is your IAS 23, and your government grants is IAS 20. Okay, so in this one chapter, we are going to cover all of these standards. Okay, how many standards? One, two, three, four, five, six, seven. So we are going to study seven different standards. So, guys, IAS and IFRS. So IAS were introduced before, like when they created the standards, when they were developing the standards. So IAS series was first developed. And when they started revising some of the existing standards, then they created a new series of standards, which are IFRS. Okay, so IAS stands for International Accounting Standards. IFRS stands for International Financial Reporting Standards. For some of the uh, elements of financial statements that we will be studying, we might study the IFRS standard, and for some of them we might study the IAS standard, like for this one. So this standard was introduced way years later after all of these standards. So this IFRS is under the new series of standards that were introduced. Okay. So let's get started with our very first standard, that's IAS 16, Property, Plant and Equipment. Okay, so what is property, plant, and equipment? This definition is very important because you might use it in your exam. Okay, so again, I told you before, then in the exam, you will be given the case study. You will have to identify what standard is applicable. So when you're identifying what standard is applicable, for example, in the case study, they have given you details about some machinery, right? They are saying you, oh, they acquired a machinery and whatever the rest of the case fact states later. But in the initial stage, they tell you this is like this is a machinery, and then they give you some of the other information as well. And that information might be, okay, they acquired this machinery, how should they recognize it, or there is some revaluation, or there is some impairment on that machinery, like a lot of things that they will be mentioning you in the case, right? So when I'm saying that if in the case study there is a machinery that's mentioned, right? So how would I explain to the examiner that IAS 16 applies on this machinery? How would I explain it? I would Basically, I would identify that machinery is being discussed in the case study, and machinery meets the definition of property, plant, and equipment. And because it meets the definition of property, plant, and equipment, then I will apply the rest of the rules and regulations, rest of the principles that the IS 16 tells us. So, for every standard that we will study the definition as the very first thing. Okay. Once we study the definition, we will study what should be the initial recognition, right? Then we will study what should be the subsequent recognition. Okay. Then we will study what are the presentation or disclosure requirements. Or disclosure requirements. So these four things we will be studying for each and every standard. If you want to prepare for each standard, you should know these four things. Okay. So let's get started. What is PP&E? So PP&E is our property, plant, and equipment. Anything. IAS 16 defines property, plant, and equipment as tangible. Tangible, this is important. Anything I can touch, anything I can see, okay, anything I can transfer, like by physical touch, right? So that is tangible. For example, machinery, I can touch the machinery, I can see the machinery, right? So that is tangible. If I'm talking about a software, right, for example, a software like Tally, or a software like Google, right? So this is something I cannot touch, right? I cannot touch it. So physical touch is one of the most attributes which would meet the definition of tangible. Like it should be tangible. You can actually see it, you can actually touch it, right? You can actually pick it up and transfer it somewhere, right? So touch, physical touch would meet the definition of any tangible item. So anything that's tangible, a building, a vehicle, a machinery, an equipment, your laptop, your table, your furniture. Okay, these all items come under tangible. So any thing that is tangible and that is held for use in the production or supply of goods and services, for rental to others, for administrative purposes. Okay, so first thing, it should be tangible. And if it is tangible, it should meet this criteria and it should meet this criteria. So first criteria is it should be held for use in production or supply of goods and services. What do you mean by this? For example, you have a business of producing plastic water bottles. Okay, so you are basically making you have a company that manufactures plastic water bottles, right? So if there is a machinery that is kept in your factory where you're doing the production, and that machinery is being used to produce those plastic water bottles, then that machinery is held for use in the production or supply of goods and services. Now, held for use is important, guys. Sometimes something is not in use yet, but it is available for use. It is held for use, right? So it should be there for use. It might not yet be in use, like they're not utilizing it yet, but it is held for use. It is kept in the business for use. So this is important. Okay. Or first thing, this. Second thing, for rental to others or for administrative purposes. So second thing is rental to others, right? You have, okay, you already have a very big company. Okay, and then there is another building that was uh additional, like that you were not using for your business purposes, because that was the building which you were using before for your business purposes, but now because you don't need it, so that building is empty now. So now you have rented out that building to some other third party for some additional income, for some passive income, right? So it is used for rental to others. So that also meets the definition of your property, plant, and equipment, or for admin purposes. Now, if you have a factory of water bottles, right, then you might have a one office building that you are where all your admin staff is, right, where all your receptionist or all your corporate governance meetings, your board meetings are occurring. Okay, your financial accounting is being done in that office building. So if it is not used in the production or supply of goods and services, it could be used for your administrative purposes. Okay. Or it should be used for rental to others, like you have rented out something to the third party. So if these three things, any one of these things, okay, not all of these things, but if any tangible item is being used in one of these things and it is expected to be used for more than one accounting period, for more than one period, then it meets your definition of your ppe. Okay, so for example, if you purchase any machinery that you will be using for production and supply of your water bottles, and you will be using it for more than 1 year, for a couple of years, or 5 years, or 6 years, then it would meet the definition of your property, plant, and equipment. Okay, understood? Okay, perfect. Okay, sounds good. And now, initial recognition. So, for example, okay, again, here we have the statement saying tangible items have a physical substance. Physical substance, you can touch it. Okay, you can see it, that it's there in front of you. Okay, initial recognition. So when you have bought a machinery, okay, so now how you want to recognize in your financial books, how you want to recognize it in your books, in your financial statements. So an item of property, plant, and equipment should be recognized as an asset when it is probable that the future economic benefits will flow into the entity. The cost of the asset can be measured reliably. So again, going to that example of machinery for water bottles, you're purchasing the machinery for water bottles, right? Why are you purchasing it? Because it will help you to produce or to manufacture water bottles, right? And then when you manufacture your water bottles, you will be selling it. When you will be selling it, you will be generating your revenue, right? So when you will be generating your revenue, it will bring future economic benefits to your entity. Now, one thing, guys, this thing you might not study in the textbook, but future economic benefits. These can be earned by two ways, okay? First should be generating income. Okay, you are generating income. For example, you've bought a machinery that will help you produce your water bottles, and you will sell your water bottles, and then your revenue will be generated. First way of future economic benefit is to generate income, and the second way of future economic benefit is to save cost. Okay, so anything that is economically beneficial would either be able to bring additional income into your entity, or it should be able to save the cost of that entity. So if any of these two things are being met, then you are meeting this definition. Okay, so for example, now you have been using this machinery you purchased for your water bottles for like 5 years now. Okay, you've used this machinery for 5 years now. The efficiency, like earlier when you purchased it, one machinery would produce 1,000 water bottles in 1 hour. Now because you have used the machinery for 5 years, then you're like then your that same machinery is producing like 100 bottles in 1 hour. So the efficiency has decreased. Now you can do two things: either you change the engine or the main component of the machinery, or you bring new machinery, right? If you bring new machinery, then the new machinery would basically also help you in generating income, but because the efficiency of the first machinery decreased, the second machinery which you are bringing will help you save cost, right? Because in year 5 your cost has increased so much that when you bring a second machinery that is more efficient than first machinery, then it will help you save cost. Then or when if one machinery is producing 100 bottles in 1 hour, and you're bringing new machinery, or you're changing the major component, you're changing the engine or something like that in the machinery, that would help you to produce like 1,000 or 2,000 bottles in 1 hour, then that is saving cost. Okay, so it is probable. Probable is like higher chance, like more than 50% of the time it is probable. Okay, and the cost of the asset can be measured reliably. So if you have bought something and you don't know the cost, you cannot measure it reliably, then you cannot recognize it. But if you have purchased an asset that you're probable it will bring future economic benefits into the entity, the cost can be measured reliably, then you can recognize the asset in your books. Okay. Okay, so now, property, plant, and equipment. So they have told you that how, when you should initially recognize the asset. But now, the most important thing for you is how to recognize your PP&E. Just give me 1 minute, guys. Okay. Okay. So how you should be recording it? PP&E should initially be measured at cost. Initially means first time. If you're buying your asset on March 21st, 2025, right? Then initially is when you're recording it on the day you have bought the asset, right? Initially, the first time when you're recording an asset into the books should be measured at the cost. And the cost should have your purchase price Purchase price, you paid for it, right? You paid for it. Costs that are directly attributed to bringing the asset to the location and condition necessary to operate. So, for example, you bought a machinery from X location, for example, New Delhi. Okay, but your factory in which you're preparing your manufacturing your water bottles is in Chandigarh, is in Chandigarh. So the purchase price of machinery is 50,000. Okay. So you paid 50,000 for your machinery, right? And now this is just the purchase price. But to bring the machinery from New Delhi to Chandigarh would charge you additional $1,000. Sorry, INR. 1,000 Indian rupees. Okay. Sorry, guys. My writing is a little bit not good. So, to bring the asset from New Delhi to Chandigarh would take you additional 1,000 rupees, right? So this 1,000 rupees was the cost that was directly attributable to asset. Directly attributable means something that you're only incurring because you have bought the asset, right? You would not have incurred this 1,000 rupees cost if you have not purchased this. So this $1,000 cost is directly attributable to the machinery purchase that you're doing. Okay. And bringing the asset to the location and condition necessary to operate. Okay. So if you would have not bought your machinery from New Delhi to Chandigarh, then you would not be able to use it in your factory, in your goods. So that is the directly attributable cost, right? Sometimes installation cost, right? So here the major cost that they're covering is delivery and installation cost. Like, for example, you buy an air conditioner, right? So you buy an air conditioner, delivery cost and the installation cost. Like there will be a serviceman from the vendor side who will come at your home, who will install your AC, right? So that cost and your delivery cost should be the directly attributable assets. Plus, the estimated cost of dismantling and removing the asset, including any site restoration cost. This might apply where an entity has to recognize a provision for cost of decommissioning an oil rig or nuclear power station. So I know, guys, this point might be like, what is this? Okay. So when I'm working in public practice, I have worked in some of the mining companies. Okay. I have worked in some of the mining companies. So what they do is when they are doing the mining, so they drill the like first of all they select the location, right? To that location we say site, right? Where they will do their operations. And then they do some drilling there, right? They drill underground, and then underground they drill and drill and drill to find the like minerals, like, or some of the times there are like gold mines or diamond mines. Okay, so they drill to get the gold, to extract gold or to extract silver or to extract diamonds, right? So they have these sites that they work on, right? So what government says is that, okay, if you are extracting resources from these sites, when you are done with your operations, you have to restore the site. Okay, when you're done with your operations, then you have to restore the site. You have to leave the site in a way that it was before you started working on it, right? So if I'm doing all the drilling and I have messed up that site, so when I'm done with my drilling, when I'm done with my extraction of resources, I will work on that site to restore it, to make sure that site is in the same condition as it was before I started working on the operations, right? So I have to do expenditure on the restoration of the site. So anything that I will have to incur 5 years from now. Okay. So for example, I am working on a gold mine. Okay, I'm working on a gold mine, and I have, today is 2025. This is today. And I started working on it. Okay, so now year one, year two, year three, year four, and year five. Year five. Okay, so I do the I bring all my manufacturing equipment, my drilling equipment, and I start digging the site today, okay? But then I know this thing that after 5 years, I will have to restore the cost. So what accountants do is, what they do is that if, for example, current cost is $1 lakh, okay, current cost for drilling and everything, whatever they're doing is $1 lakh, but then after 5 years it would take them additional $20,000 to restore the site. Okay, so this future value, like in the future year they will have to incur $20,000, right? So what they do is, this is an estimate that they create. So, and this estimate is what they will be incurring after 5 years. This is our future value. So, I don't know if you have studied corporate finance or not, but if we are recognizing a cost today, then we will bring the future value to the present value, to year zero. Okay, so this is the value at year five, and we have to calculate what should be the value of 20,000 at year zero. And whatever the value comes, to that value we call it as present value. And then that present value gets added to my purchase price. That present value gets added to be my cost. Okay, so for example, 100,000 was all the cost of equipment, drilling equipment it took me to dig a site, plus the 20,000 is my future value, right? But when I will convert it into my present value, I will do the calculation now. But for example, if it is 16,000, just an estimate, guys, I will do the present value calculation. If it is 16,000, then I will add 1 lakh plus 16,000. 1 lakh 16,000 will be the part of my actual cost. Okay. So how you do the present value calculation? There should be, okay, let's do it now. Give me 1 minute. Let me just open Excel for you, and then let's do it. Okay, share screen. Okay, go ahead. Oops. Okay, so for example, present value of my, oops, sorry. I need future value of site restoration after 5 years is 20,000. It's 20,000. Okay. And for example, the interest rate or the effective rate of interest is 10%. Okay. And the number of years is 5. And we have to calculate the present value. Right? So guys, why I'm doing this in Excel? Because when you will be writing your actual exam, you will have Excel with you. So I can also do it in the another way, but like this is the most like efficient and effective way of doing it. Let's use the Excel function, okay? So I will use the Excel formula for calculating my present value. The rate should be 10%. So I will just write it like 0.10. Number of years should be 5. payment is 0. There's no payment in between, and future value is 20,000. Okay. And then the type is like 20,000 should be at the end of 5 years, right? So I will use 0 here. And then this is what should be the present value of my 20,000. Okay, so now how it works is like initially at year 0, I would recognize 12,418.43 as part of my cost, right? And then in year 1, what I will do is, let me show you like this. Capitalized amount, interest rate, uh, amortization, or sorry, just give me. Okay, interest applied, and then the ending value. So what I'm actually doing it, I'm compounding it. I'm actually like at year 0, I have recorded 12,000 as my present value. Now, after 5 years, I want to make sure that when I do accounting each year end, I want to make sure my this 12,000 comes to the 20,000, because then how the present value and future value, this is how it works. Although I expect most of you might have studied corporate finance, so would have an idea how this is done. But if not, then yeah, just doing it for your sake. Okay, so interest. So this is the capitalized amount. And then how much should I have to apply on this? Should be 1.10, right? Because I'm actually, okay, so let me just do it. 10% for year 1, and then the ending value should be this plus this. So this is at my year 0. This is the interest that I'm applying after year 1, and this is the ending balance that I will have at my year 1, at the end of my year 1. And then my ending value of year 1 will be my opening value for year 2. Then I will apply again the interest on the opening amount. And then again, this would be how I get it. Ending value, this ending value will be for year 2. And then I would just do it. And this will be for year 3. This will be for year 4. And this will be for year 5. So you see, at year 1, I recognized this amount. And at year 5, when I have to actually incur $20,000 to restore my site, I will have 20,000 in my books. So this is how present value and future value works, right? You can also calculate it like this into 1.10 times 5. Okay, so this is what you will get if you're just using the compounding formula. Okay, so that's how you do it. Or if you don't want to calculate the present value using the Excel, then how we do it? Present value at year 0, 1, 2, 3, 4, and 5. Okay, so if I want to get the present, so first thing I should know is to calculate the PVF. PVF is my present value factor. So I'll calculate my present value as 1.10 apostrophe minus 1. And then I'll just drag it for the 5 years. Oops, sorry. 3, 4, 5. Okay, and then I will get my future value, which is 20,000. And I'll just multiply this with this. Okay, so I'll just fix this one. I'll press F4. Oops, this should be 0. That's for the payment. Then I'll just multiply this with this and I will get my present value. So this is the present value after year 5. So for example, someone tells you that, okay, calculate the present value after year 4. Like what should be the present value if they have to incur the site restoration cost after year 4? So I will do 1.10 SBR minus 4 and I'll just multiply this into this. So I'll get 13660. So this will be my present value if I have to incur my site restoration cost after 4 years. Okay, if you have any questions on this one, just let me know. But I think it should be easy for you to understand how this present value and future value concepts work. Okay. Okay. So, okay. So, we have covered these three very important aspects. What should be the part of our cost? It should be the purchase price, our directly attributable cost, and our dismantling cost. Okay. Now, Now, IS 16 says that there are some costs that should never be capitalized. Never means never. So, these are the things that you should memorize because these components or these kind of examples will definitely come in your case study, and then you should remember, okay, if there's any admin expense, then it should be expensed. It should not be capitalized, okay? Admin expense, general overheads, your abnormal costs like repair, wastage, idle time. Why this? Why are we not capitalizing it? Because all of these things do not meet definition and recognition criteria. Okay, what is the definition and recognition criteria? This is the definition criteria. This is the recognition criteria. So to capitalize anything as PP&E, both of these should be met. Okay. So abnormal cost incurred after assets is physically ready for use, anything that's okay, like maintenance services, right? Maintenance services are incurred once every year or once every few months, right? So those are incurred after asset is ready for use. So they do not help in generating future economic benefits that would be applicable for more than one accounting period, right? So that's why they are not capitalized unless these costs increase the economic benefits that asset brings. For example, if you have a vehicle and you have used that vehicle for like 5 6 years, but now that vehicle has depreciated a lot, that you need to change the engine of the vehicle. So if you're changing the engine of the vehicle is not a regular maintenance service, right? It is a big expenditure that would help to increase the efficiency of your vehicle, right? That would help you decrease the cost and generate more income, right? So if there is any expenditure you incur that would increase your efficiency, right? That would increase the economic benefits, then you can capitalize it. Again, guys, remember for economic benefits, these two things, any one of this thing would meet the criteria of future economic benefits, generating income or saving cost. Okay. Saving cost means being efficient, right? Cost incurred in the initial operating period, such as initial operating losses, further cost incurred before a machine is used at its full capacity, right? So, the kind of cost like initial losses, you're not going to capitalize it. No. IS 37 also has like one component which includes onerous contracts. So, onerous contracts are like contracts which would give you like initial losses, but then the standard is very clear that any initial losses should never be capitalized. Cost of opening a new facility, introducing new product, conducting business in new location with a new class of customer, including training cost. Guys, remember this training cost. So many times a case study would mention that, oh, training cost was incurred and they capitalize it. So that is a red alert. That's a red flag for you, okay? So you don't have to capitalize the training cost. The standard is very clear what you should be capitalizing and what you should not be capitalizing. Okay. So, as a result of testing, recently purchased or constructed PP&E product samples might be produced that are sold. IS 16 has been amended to require proceeds from such sales as well as associated costs to be recognized in the statement of profit and loss as income. Okay. So, if you are conducting any test on the asset, okay, if you're conducting any samples on the use of the assets, and those samples might be sold, right? So, whatever income you're generating from selling of those samples should not be capitalized. Why? Because that samples, or that initial testing that you're doing is not going to bring you future economic benefits, right? It is not going to, that cost is not going to increase the capacity of the existing PP&E. So they are not recognized as an asset. Instead, they are expensed. Okay. So I hope this is clear to you guys. And then comes measurement models. So now what we have saw is we have seen what is the definition. We have seen the initial recognition. In initial recognition, we have seen what is the criteria to recognize and what should be recognized. Should be recognized. Okay, so we have studied this. Now, what should be recognized and is done? First step is done, second step is done. Now, the third step is how you should be measuring it. Okay, what you should be doing to measure your asset. So, there are two models that your standard explains you. Okay, so two models that you will be covering would be your cost model and your revaluation model. Okay. Oops. Yeah. So cost model and your revaluation model. So cost model is very simple, guys. Cost model means recognizing at the cost initially and then just amortizing it or depreciating it. Right? Depreciation and then cost minus depreciation, you get your carrying amount. Right? Now, depreciation is either straight line or either your depletion or 1 minute. Okay, so depreciation is either your straight line or your declining balance, right? So, straight line, you have been studying it since your 11th standard or your graduation. For example, if you have cost of your asset, right, it's 10,000. You're going to use that asset for 5 years and you're going to use the straight line method. So you're going to divide 10,000 minus any residual value that you get, divide by 5 years. So for example, residual value in this case is 0. So each year the depreciation would be 2,000. per year. Okay, so this is the cost model. This is the simplest model. Cost model. Under cost model, PP&E is held at cost less any accumulated depreciation and amortization and impairment losses, right? So you have calculated here depreciation. So for example, in year one, your cost was 10,000. You charge depreciation for 2,000. Your carrying amount is 8,000, right? In year two, again, your this is your cost and this is your accumulated amortization, right? And in year two, again, you will charge your amortization for $2,000 again because this is straight line method that we are following, right? So the total accumulated amortization after your 2 years will be 4,000 and then your carrying value would be 6,000, right? So 6,000 would be your carrying amount. 4,000 would be your accumulated depreciation or accumulated amortization, whatever you want to call. So, guys, in IFRS, I'm so sorry, in IFRS, we use the term depreciation for all the tangible PP&E and we use amortization for intangible. Okay, so I'm also studying CPA. So there are some gaps for specific countries, and according to that gap, they use the word amortization and depreciation interchangeably. Like IFRS is very clear. If it is a PP&E, then it should be depreciation, and if it's an intangible asset, it should be amortization. But some of the gaps, like I'm studying Canadian gaps. I've also studied US gaps. So in Canadian gaps, like a Canadian specific standard, like which is not IFRS, but which is like for private companies. So in that case, they use amortization also for like tangible assets like PP&E. So that's why I just keep using this word. But yeah, for IFRS, we should always use depreciation. Okay. So 4,000 will be your accumulated depreciation, right? And impairment losses. So, guys, if there has been any impairment means fall in the value. Like today, your asset, you are saying it's for 8,000, but in market, it's for 6,000, right? Or, okay, let me talk it at year two. So, at year two, your accumulated amortization is 4,000. Your carrying amount before impairment is 6,000, right? Because your cost was 10,000. So 10,000 minus 4,000, you get 6,000, right? Now, you get impairment. You say, okay, in your books, your asset is for 6,000, but in the market, the asset is just worth 2,000. So, your impairment will be 4,000 and then your carrying amount will be your 2,000. So that's what the standard is saying. That cost model, cost is your 10,000 less any accumulated depreciation. Accumulated depreciation is your 4,000. And then any impairment losses additional 4,000. So this is your carrying amount of your 2,000. So that's what the standard is saying. Okay, then comes revaluation model. So this is the second model. This is a model that's different than the cost model. So in this model, the PP&E is carried at fair value less any subsequent amortization, accumulated depreciation, and impairment losses. So in this case, we are keeping everything at cost under cost model, everything at cost, less accumulated depreciation, less impairment losses. But revaluation model says that if you are following my model, then you would have to revalue the class of that asset at each year end. Okay, why this word subsequent is here? Because, for example, at year two, the carrying value of the asset was 6,000, right? But you're following revaluation model. So everything is same. Like at 10,000 minus 2,000, 8,000 was your carrying amount, right? And then, okay, let's keep it at year one. So at year one, year one, your carrying amount was 8,000, and then you revalue the asset to your market value, right? At the year end, and you find out that your asset is should be valued at 2,000, right? So 8,000 to 2,000, then there's a jump for 2,000. In revaluation model, we revalue the asset to the fair value. Fair value means anything that I can get by selling my asset in the fair market. Like if I go in the market, I bring my machinery and I want to sell my machinery in the market at a non-arm's length, at arm's length transaction, then I would like to, what amount will I get when I sell this item, right? So if I'm selling my machinery to a stranger, right? Then how much money I'm going to get for my machinery? If 10,000, then I'm going to revalue my asset from 8,000 to 10,000, and I'm going to record this 2,000 as my gain. Okay, so revaluation model says that your PP&E should be recorded at fair value less any subsequent accumulated depreciation and impairment losses. So, why subsequent depreciation? Because you've already revalued your asset to 10,000. Now the depreciation would start again from year 2, right? At year 1, your depreciation was 2,000 a year, right? Because you were saying, oh, my useful life is 5 years, so my depreciation should be 2,000 per year. But now at year 2, you have 10,000 as your book value, and the remaining life of the asset is 4,000. So now your depreciation would be 2,500. So it is subsequent accumulated depreciation. Any depreciation that you charge after you have valued your asset to your market value. If revaluation model is adopted, these are the rules that we must follow, guys. And these rules, you would be writing it in your case study if your case study comes for your revaluation asset. Okay. So revaluation must be made with sufficient regularity to ensure that carrying amount does not differ materially from the fair value at each reporting date. So, what does the statement is telling you? The statement is telling you that if you adopt the revaluation model, then every year end you have to do the revaluation. Okay, every year end. Every year end means at each reporting date. If you adopt your revaluation model in the asset acquired in 2025, then all the subsequent year ends 2026, 2027, 2028, at each year end, December 31st, if December 31st is your reporting year end, then at each year end you would be revaluing your asset to see what is the price that your asset can get in the fair market, in the fair market value, and then you would revalue your asset to that fair value. Okay, if item is revalued, entire class of the assets to which it belongs must be revalued. Now, some people ask me, what do you mean by entire class of assets? Entire class of asset means, for example, you have bought machinery X, right? Machinery X for 25,000, and you decide that you want to adopt a revaluation model for machinery X. Then, not only machinery X, but all the machineries that are part of your this class, all the machineries, if you have pooled your assets into one class, like all the machineries, machinery X, Y, Z, A, B, C, all the machinery should be used revaluation model. Okay, not just, you can't do, if you have two machineries, you have X, Y, Z, you can't be like, oh, for this machinery I'll use revaluation model, for this machinery I'll use cost model, and for this machinery I'll use revaluation model. No, for all the machineries you should be using one model, that's revaluation model. If revaluation increases the value of the asset, the increase is presented as the other comprehensive income, and item will not be recycled to profit and loss in subsequent periods and held in revaluation surplus with other components of entities. So you would be like, what is this? What is other comprehensive income, right? Okay. So to make it easier for you, when we present our statement of profit and loss, our income statement, so what we do is we have revenue, expenses, right? Or cost of goods sold, right? And then we have like our gross profit, and then we have our office expenses, our rent, insurance, all other activities, and then we have net income from our business, from our operating activities, right? So net income or profit and loss, we have maybe X amount. Okay. Sorry, if it's a loss, then it's negative, but mm, for example, we have net income that's positive, like we have profit. Okay. And loss if it's C, loss if it's in negative. Okay. Right? So now this is how we normally present, right? Our income from operations, like income from our regular operations of the business, right? But then down below we have other comprehensive income. Okay, and under other comprehensive income, we show revaluation gain or loss. Oops. Okay. Revaluation gain. And there are some other things as well. For example, unrealized gain or loss. Like you will study this later on, specifically in IFRS 9, but like this is the normal income statement, and we have our net income from the operations, and then we have like other comprehensive income. Like below, this is a presentation, right? This is not something like calculating something, but this is presentation, that when you're presenting your other like your revaluation gain or loss or your other unrealized gains or loss, then you have this heading in your income statement as other comprehensive income, and then here you recognize your revaluation gain, and then when you recognize both your net income from your operations and your other comprehensive income, then that is your total net income for the period. Sorry for my writing, guys. I'm just trying to write nicely, but my writing is not good. Okay. Net income for the period. So the net income for the period would be this plus this, like if you add it, and then this would be your other comprehensive income. So that's what this point is saying. This point is saying that when there is a revaluation gain, then the revaluation gain is presented under, it's disclosed under other comprehensive income, and that item will not be reclassified into P&L into subsequent periods. Okay. Okay, so what happened is you recognize revaluation gain. This would go in your income statement. Okay. This is part of your income statement, your other comprehensive income. And on the equity side, there will be a surplus. There will be a reserve, and that reserve will be revaluation surplus or revaluation reserve, whatever you want to call it. And then if there is revaluation of say 2000 here in the income statement, then there will be revaluation reserve of 2000 under your equity side, in your balance sheet side, or you can also see this in your statement of changes in equity. Okay, so if there is a gain, then everything that you record in accounting has a debit and a credit side, right? So this would go into your equity and this would go into your income statement, right? So that's what this point is telling you. If revaluation decreases the value, the decrease should recognize immediately in P&L unless there is a revaluation surplus already existence in the same asset. So this is something very important, guys. What they are saying is that, for example, in year one, you had a revaluation gain of 2000. Okay, understand this very carefully. In year one, you have a revaluation gain of 2000. Okay, and in year two, because revaluation model says you have to apply revaluation model with sufficient regularity, which means at each reporting period, right? So in 2025, you did it. And now in 2026, you again tried to revalue. But now, when you go into the market and you see what is the price for your asset, then the market tells you that your asset has decreased in value. Like, for example, if you did this revaluation, your asset increased to 10,000, okay, and then 10,000 you charge depreciation, on the 10,000 you charge depreciation of like $2,500, and then your carrying amount at the end of year 2 would be 10,000 minus 2,500, which would be 7,500. Okay, so this would be your carrying amount at the end of year 2. Now you're revaluing it. Now you're saying, okay, this is my carrying amount and this is my fair value. My fair value, you go in the market and they tell you that your fair value has is just 6,500. Now what happens? 7,500 you have recognized in your books, and market is saying that because you are following revaluation model, you will have to recognize your asset at fair value. So your fair value is 6,500. So now there's a drop of $1,000, right? So now how you should be recognizing this $1,000? So the standard says that this amount would first be adjusted with the revaluation reserve. So you remember in year 1 we had revaluation reserve of 2000, and then in year 2 when there is an impairment, then we will adjust this revaluation, this impairment loss with first our revaluation reserve 1000, and now our revaluation reserve is remaining at 1000 at year 2. Okay, I hope you understand this. So if there is a drop in value of the asset, then we would first adjust the drop in the asset value, the impairment in the asset value with already recognized reserve. Okay, so now 1000 would, how it will be adjusted? It will be adjusted with your reserve and it will not go into your P&L. Okay, so now, for example, you want to record it. You want to record your, uh, okay, let me just give you one more example. So now, for example, this was case 1. Okay, now case 2, they're saying carrying amount is 7,500, but fair value is 4,500. Okay, so your impairment or your drop in value is 3,000, right? So now in this case, what you will do? You will go to revaluation reserve first because your revaluation reserve has how much? 2,000, right? From year 1, your reserve has 2,000. So what you will do now? You will adjust 2,000 from your reserve. Okay, you nailed your reserve. It should be 000, and then remaining 1,000 will go to your P&L, will go to your income statement. Income statement. So how you should be recording it? How you should be recording it? This is very important, guys. How you should be recording it. Okay. So let me just clear this again. Okay. So for example, if there is a revaluation gain, right? So you debit your asset for how much? 2,000. And then you credit your revaluation gain, right? Your revaluation gain would actually go to your other comprehensive income, right? So your asset will go into balance sheet and your revaluation gain would go to other comprehensive income, right? And once you include this as your other comprehensive income, under your statement of changes in equity, there will be a reserve for revaluation, which would show you $2,000 there as well. Okay. So this is how you're recording it, your initial revaluation gain. And now there is impairment, right? And now you have recorded a drop in value. So I will tell you what should be the entry for your second case, like when the impairment was for 3,000, like when the drop in value of the asset was for 3,000. So now what I will do is I will recognize impairment loss for 1,000, right? I will debit my revaluation reserve or my okay, revaluation reserve for 2,000, and then I will credit my asset account by 3,000. So this is what I'm doing. I'm debiting my impairment loss. I'm debiting my reserve. That's part of my equity. So this is my equity. This is also my equity, guys. Other comprehensive income is part of equity, okay? It's part of your equity. Okay. So this is your income statement. This is your equity, and you're reducing your asset in the asset section of your balance sheet. So this is how you record it. Okay. So for any entry, okay, let me just do it here. If there was no revaluation reserve, if there was no revaluation reserve, if in year one there was no revaluation gain, but instead there was a loss, so then how you would record it? Then you would record it like impairment loss debit and your asset credit for, if say 2,000, then 2,000 here, 2,000 here. Asset credit because asset has fallen in value, right? Impairment loss means expense has increased. So that's why I'm debiting my loss. Okay. And one thing more, if you are unable to understand this section under IAS 16, then don't worry, guys. We are going to retouch this section again when we will be studying our IAS 36. Okay. So when we will be studying our IAS 36, we will be retouching these two statements again. Okay, but I tried my best to make you understand, but because these two things are related to IAS 36, so it will make you more sense when I do that. Okay, we will be doing all the journal entries, all the different sort of cases in IAS 36, but just to make you understand what the standard is saying, I tried my best to explain you. Okay, if you have any questions, then please let me know. It's very important. Okay. Okay. Now, for depreciation. Now, depreciation is one of the easiest topics. Depreciation, all PP&E with finite useful life must be depreciated. Depreciable amount is cost less residual value. So, you know everything, right? Cost minus residual value divide by useful life is your depreciation per year. Okay. Residual value is something that you will get when you sell the asset, right? So if I've bought machinery today, after 5 years, when my machinery is all, like used, and I would be scrapping it, how much will I get for my scrap? Maybe $2,000. So if I purchase machinery for $50,000 and I will get my residual value after using it for 5 years, I'll get it 2,000, right? So my depreciation would be 50,000 minus 2000, and if I'm using it for 5 years, it will be 48,000 divide by 5 years, whatever it is. Okay, so you can calculate your depreciation expense in that way. Depreciation is charged to P&L. You all know that. What is the entry for recording depreciation? Depreciation expense debit, right? And accumulated depreciation credited, right? Depreciation, and this depreciation expense goes to income statement, and your accumulated depreciation is shown as the negative side in your balance sheet. So in balance sheet, when you have an asset, you show the cost 50,000, accumulated depreciation for say 3,000, then your net book value in the balance sheet will be 47,000. So that's how you show it. Depreciation begins when asset is available for use and continues until the asset is derecognized, even if it is idle. So guys, this is very important point. It is tested multiple times in the case study. They tell you, oh, you purchased an asset, but it is available for use, but you have not used it yet. So depreciation will start recognizing from the day you start when the asset is available for use, and not when it is being actually used. If it is there, if it is sitting in your factory and you're not using it, doesn't matter. If it is available for use, then you have to start depreciating it. Now, this is the depreciation definition. Depreciation must be allocated on systematic basis, reflecting the pattern in which the asset's future economic benefits are expected to be consumed. In many entities, depreciate property, plant, and equipment on straight line basis over its estimated useful life. So they are just saying that depreciation expense. What is it doing? What is it doing, guys? 1 minute. Okay. So let me just. Sure. Okay. Okay. Perfect. Okay. So what is depreciation doing? Depreciation is basically decreasing your asset value over the number of years you would be using it. So if you're going to use your depreciation for, uh, if you're going to use your asset for 5 years, so then you're going to depreciate it for 5 years. That after 5 years, the value of your asset should be zero, or it should be equal to your residual value, right? So depreciation methods based on the revenue generated by activity are not appropriate. This is because revenue reflects many factors such as inflation, sale prices, sale volumes, rather than economic consumption of an asset. So this is something you have to keep in mind. Again, in the case study, they sometimes tell you, oh, they use different sort of method for depreciation based on revenue or based on cost or based on volume of production, but then it should not be used in that way because it is not appropriate. It does not show the actual consumption of the asset, right? The depreciation method, residual value, and useful life of an asset should be reviewed annually and revised if necessary. Any adjustments are accounted for as a change in accounting estimate. So, as a change in accounting estimate. So, this is important. So this thing we will be studying in IAS 8. Okay, so for this one, you can just ignore it for now. We'll be studying it for IAS 8. Okay. Last part of our, not the last, but closer to the last part of our IAS 16 is componentization. So, okay, try to understand this thing now. Is that, mm, let me just erase all of this. Okay, perfect. So now see, there is an aircraft. Okay, in aircraft, you have so many multiple assets together, right? Like there is engine, right? There is hard body, what should we say, like hard body of the craft. There are seats, right? Um, there are some cabinets, right? There are wheels, right? So all of these, or maybe XYZ more, more, like so many components make up one aircraft, right? So for example, if I pick up seats from all these multiple assets, okay, so seats could be wear and torn faster, like there would be a faster wear and tear of seats, maybe say 5 years, right? Hard body of the aircraft could live up to like 10 to 15 years, right? Engine, maybe 10 years or 7 to 8 years. Not sure, guys. I'm not expert in this. Wheels, maybe 3 to 4 years. Cabinets, 7 to 8 years again, right? So componentization says that if an asset is made up of multiple assets, it's made up of multiple components. So multiple assets together form components. So IAS 16 says that if each component of the asset has a different useful life, right? So we should depreciate each asset, each component according to its respective useful life, right? So if cost of hard body of the aircraft is $1 lakh, right? And its useful life is 10 years. So I would depreciate it at 10,000 each year, right? If the seeds have cost of $30,000 and its useful life is 5 years and its residual value would be 2,000, for example. So how much would be the depreciation? It would be 28,000 divided by 5. It would be around 5,600 per year, right? So that's how you calculate it. So componentization says that for each part, you should be depreciating it individually. Some parts of the assets may require regular replacement. Very good, like seats require regular replacement. The replacement part should be capitalized and the carrying amount of that part being replaced should be de-recognized. Okay, so now for example, I am replacing the seats. Okay, just give me 1 minute. Okay, so if I am replacing the seats, so for example, I have used seats for 5 years. Okay, for 5 years, I've used the seats. Carrying value after 5 years is, for example, 2,000, right? And now after 5 years, I need to replace my seats. So the new cost of replacing the seats is again $30,000. For example, if I'm replacing it with new seats, it should be $30,000, right? So now what this thing is saying that you de-recognize the existing cost. So I would do is I would credit old seats, right? I would debit new seats, right? So if I'm crediting old seats, they are for 2000, right? If I am able to sell it for 2000, right? If the residual value is 2000, I've got cash in respect of 2000, then I will debit cash because I sold it for $2000 cash. But if I did not get anything in return for this old seats, right? Old seats are sitting in my books at 2000 and I did not get anything in return. So what I will do, I will debit my expense account or debit my income statement, right? I would debit it, expense, I would say, or loss on replacement, something like that, right? I would debit it and I would credit my old seats. If I have purchased new seats for 30,000 and I've paid cash for it, or if it's sitting in accounts payable, cash or AP. So I would credit AP or cash for $30,000. So what I did, I de-recognized my old seats. I credited my old seats. I just removed it from my books. I recognized expense because I've lost $2,000. If I've not received in cash, it's my loss. So I've recognized my loss on disposal or loss on replacement, whatever you want to call it. I debit my $2,000 and credit my old seats to remove it from my books. And then I debit my new seats for $30,000 and I credit my cash, the amount that I pay or what I have to pay, right? So the replacement parts should be capitalized, new seats capitalized, and the carrying amount of parts being replaced, old seats should be de-recognized. If the carrying amount of the replaced part is not known, then the cost of new part can be used to estimate the cost of old part when it was originally acquired. So, for example, if you don't know what should be my carrying amount of my old seats, so in the case study, they will give you the information that would suggest you, okay, this is the amount that you have to use for your old seats, okay? Some assets, such as aircrafts, can only operate if regular inspections and faults are carried out. Cost of these inspections are capitalized. Any remaining carrying amount relating to previous inspection should be de-recognized as well. Okay, so if you have to incur inspection cost every year, right? Or every 2 years or every 3 years, and that is important for your functioning, that is required for your operations of your asset, then you can capitalize those costs. So for example, if every 2 years I have to incur my inspection costs, right? Every 2 years. And the inspection cost is like 5,000 for each. So what I will do is I will debit my asset for inspection cost for $5,000 and then I will credit my cash or whatever, AP, whatever, right? And then now this asset should be depreciated, right? But what should be the useful life of the depreciation of inspection? After how many years do I have to do inspection? Every 2 years, right? So I will depreciate my inspection every 2 years. So depreciation should be 2,500 per year. If inspection should be done every 5 years, then it should be depreciated over 5 years, 1,000 for each year. Depreciation should be charged separately. See, this is important. It should be charged separately on each significant component part of the item of PP&E. Parts which have same useful life can be grouped together. Okay, so that's what it's saying, that each component has a different life and they should be depreciated based on the each component's useful life. If there are some components which have same useful life, you can combine it together and depreciate it, but otherwise you have to keep it separate. Okay? And then derecognition. Now, guys, we have studied definition, we have studied initial measurement, we have studied subsequent measurement. Now, we are studying derecognition. So, whenever there is derecognition of asset, how do you record it? How do you record it, guys? How do you do it? Let's keep it very simple. You have an asset in your books. You have your asset in your books. For example, the carrying amount of the asset that you're disposing of or derecognize is 5,000. Okay? You got, for example, you disposed it off for 3,000, right? So how you should be recording this? You should credit your asset because your asset is gone. Credit the carrying amount of the asset, 5,000. Debit the cash or AR. For how much? For the amount of money that you're receiving, 3,000. And the remaining balance should either be gain or it should be loss. So now if you had asset for 5,000, you only sell it for 3,000, you'll have loss on disposal for 2,000. If you would have sold your asset for 8,000, then there would have been a gain on disposal for 3,000, right? So this is very basic. We have been studying it for years now. The asset should be derecognized when disposal occurs or if the no further economic benefits are expected from assets use. If no further, if you have an asset sitting in your books for 5,000 and you know you are not going to get any money from it, then you just recognize loss on disposal. Loss on disposal 5,000 and then credit your asset for 5,000. Okay? The gain or loss of derecognition is the difference between the net disposal proceeds, if any, and the carrying amount of the item. When a revalued asset is disposed of, any revaluation surplus may be transferred directly to retained earnings or it may be left in the revaluation surplus with the other components of equity. Okay, so I hope this part is clear. The gain or loss is the difference between the proceeds that you are receiving and the carrying amount of the asset. Now, second point they're saying is, for example, you had a revaluation reserve for the same asset because you followed revaluation model, right? So if you're following revaluation model, you revalue each reporting year and date. And when you do it for like 3-4 years, you have a revaluation reserve which is sitting at, for example, $3,000, right? Now you have disposed of the asset. Now, this revaluation reserve is actually your unrealized gain. Why unrealized gain? Because when you were revaluing the asset each year, you revalued the asset at the end of year one, at the end of year two, at the end of year three. But are you actually getting any benefit in terms of money? Are you realizing that benefit in cash or in any sort of financial instrument? Are you actually getting that money? Because if you're following revaluation model, at year one, you revalued your asset and you recorded a revaluation gain of $3,000. Okay. But tell me, did you actually get that $3,000 or this is just a bookish structure that is? It's a bookish structure, right? You're just recording the gain in the books, but you have not actually realized it. So that's why revaluation reserve sits in the other components of equity or your revaluation reserve. Revaluation reserve is part of your equity, right? So if you see the statement of changes in equity, you will see revaluation reserve there or other components of equity. It's used interchangeably, okay? So if you have $3,000 sitting in your other components of equity, standard says you can either do nothing. You can let it sit in unrealized gain, as in other components of equity or as a revaluation gain, let it sit as a revaluation reserve, or the better thing would be to transfer this revaluation unrealized gain to retained earnings. So retained earnings, anything that you record in retained earnings is realized. Anything that you have not realized is your unrealized, and unrealized is recorded in your other components, in your other reserves, right? So standard is saying when you've actually disposed of the asset, when you've actually sold the asset, now whatever gain or loss was there on the asset, you have actually realized it. You have either got some sort of proceeds on the sale of the asset, or you have not got any proceeds. But now because your asset is gone, you've actually realized the net gain or net loss on the revaluation of that asset, right? So now what we are going to do is we can debit our other components of equity or our revaluation reserve. Why? Because if there is a balance sitting in the revaluation reserve, it would be a credit balance. Why credit balance? Because equity is credit, right? Now, there is $3,000 sitting in the revaluation reserve for $3,000 in a credit position. Now, I want to transfer that reserve into retained earnings. Why? Because I've realized it. So now I will debit my revaluation reserve because I'm nullifying it. I'm doing it zero. I will debit my OCE for 3000 and then I will credit my retained earnings for 3000, right? I will do it for 3000. So what I am doing is I'm actually debiting my reserve for which had unrealized gain, right? And I'm crediting my retained earnings, which includes all the realized earnings till date, right? So that is what the standard is telling you here. So this thing, very important, you sometimes have to write this thing in your case study if any scenario like this comes. So I hope you understand it, right? Now, the last part of the chapter is your disclosure. How do you disclose it? So, if you have any asset in your books, you have de-recognized it, you have initially measured it, you have subsequently measured it, but what is most important is disclosure. If you go on stock exchange market, you download the financial statements of any public company, you would see that after all the financial statements, after the balance sheet, income statement, statement of changes in equities presented, down below there are notes to financial statements, and those notes to financial statements are there for each element of the financial statement that you're presenting. For example, balance sheet, property, plant, and equipment, there will be a separate note for it. For example, cash, there will be a separate note for it. For example, AR, accounts receivable, there is a separate note for it. For revenue, there is a separate note for it. For any of your, for example, for your debt, for your long-term debt, if you have any long-term debt, there will be a separate note for it, which will detail, okay, this is the loans that are currently going, this is what the company owes to these parties, this is the interest rate, all sort of those things, right? So similarly, for an asset, disclosures are required. Disclosures for measurement basis. What measurement basis did you use? Did you use the revaluation model, cost model, useful life and depreciation rates, what depreciation rates you used, what useful lives you used for each class of assets, reconciliation of carrying amounts at the beginning and end of the period. Guys, this is which is there every time, which is there every time. Let me give you an example. Um, okay. So, for example, if you look up in the stock exchange, you will find the financial statement. So, reconciliation would be like what should be the carrying amount, what is the amortization charged, and what is the net book value, right? So, your carrying amount will have what was the cost at the beginning of the asset, what were the additions, what were the disposals, right? So, this is the cost. Amortization. What was the beginning balance? What was the amortization expense for the year? Minus amortization for any disposed of assets, right? And then the ending balance for your accumulated amortization, right? And then the net book value is cost minus accumulated amortization, right? If PP&E are stated at revalued amounts, the information about revaluation should also be disclosed. If you're following a revaluation model, then you should disclose in the financial statements that what sort of revaluation model, what sort of assumptions, what sort of judgments, what sort of third-party resources you used to revalue your asset. Okay? So this was your IAS 16. So we have covered definitions, we have covered initial recognition, our subsequent recognition, our models, componentization, our derecognition, and our disclosures. Okay, so I hope you guys understood this lecture. I hope IAS 16 is something that you're comfortable with. Now, next thing what we are going to do is now we are going to in the next lecture, we are going to practice some exam kit questions. Okay, exam kit questions. So, because you know how you can identify that IAS 16 is applicable, how you can explain it, okay, and how you are able to keep an answer for your final exam. Okay, if you have any other questions, just let me know. You can also um, please feel free to let me know if you have any questions. My WhatsApp number, or let me just write it in the Excel workbook. It will be more easier for you. You can contact me on +1 236 591 2180. This is my WhatsApp number. Or you can also reach out to me on LinkedIn. Okay. Yeah, but I think the best source of contact would be to just WhatsApp me. I'm available most of the time. And if I personally would not be able to talk to you, then my team would definitely reach out to you. But in most of the cases, I will be talking to you. Okay. So if you have any sort of questions, just let me know, and I would be happy to help you out. Thank you so much and see you again in the next lecture. Bye.